for managing today's interconnected risks and uncertainties. And also it's the theme of Toronto Centre because all of our work is basically about implementation of various standards and best practices. We are honored to be joined by an exceptional panel. Our friend Solange Bernstein is chairwoman of the Financial Markets Commission of Chile, who brings a wealth of regulatory and supervisory leadership from one of the region's most active jurisdictions on ESG matters. Aaron Vermeulen, finance practice lead at WWF International, whose team led sustainable banking assessment and brings deep expertise on nature-related risks. And we're very pleased to be joined by Hernando Jose Gomez, former director of Colombia's National Planning Department, a key voice at the intersection of economic development, sustainability, and financial sector policy. Moderating the session today is Socorro Hysen, who's Toronto Centre's board member and an esteemed leader in financial supervision, whose insights will guide and help us navigate this discussion. However, I was told that she has some connectivity issues. Until she's able to join, I'm very pleased that my senior staff, Demet Chanakcha, Senior Program Director of Toronto Centre, will make the conversation go smoothly. So at this
just joined, Babak.
Oh, Socorro just joined. Okay, great. So
hi, good morning.
No suspense. Socorro is back. We don't have to. Socorro, we held this seat warm for you to get ready, so maybe you can clear your throat, have a glass of water. With that, I'm pleased to hand over to our partner, Roberto Troya of WWF, for his opening reflections. Roberto, go ahead, please.
Thank you so much, Babak, and thanks everybody. Good morning, or well, good afternoon, or good evening, wherever you are. I think we're reaching people from different continents, and for that, I want to thank the Toronto Centre for putting together this event and panel. For me, in representation of WWF, it's a privilege to be with you today to talk about a topic that sits at the crossroads of finance, development, and the planet's future. Sustainable banking in Latin America. In this region, the banking sector is strategically positioned to lead transformation towards a more inclusive and sustainable development model. The region holds tremendous potential, not just because of its rich biodiversity and natural wealth, but because of the growing awareness within financial institutions and of the need to evolve in that direction. We believe, however, that awareness alone is not enough. We must accelerate efforts to close existing sustainability gaps, improve transparency and accountability, and most urgently, integrate nature-related risks into financial decision-making. This is not about protecting the environment only. It's about protecting the long-term stability of our economies and our societies. All of this is taking place in a world marked by growing uncertainty, as we can all see and live. It's geopolitical instability, climate shocks, social disruption, as Babak was saying, that are increasingly shaping the landscape in which financial institutions operate, in this case in Latin America. In this context, ensuring financial stability is not important only, it's essential. Banks that embrace this challenge stand to benefit greatly. They will help build economies of resilience, unlock new market opportunities, deepen customer trust, and support long-term sustainability. That is why this new report that we are releasing today is more than just a document, it's a roadmap and a call to action. Indeed, WWF has conducted a pilot sustainable banking assessment in Latin America. This evaluation covered 22 leading banks across 6 countries: Bolivia, Brazil, Chile, Colombia, Mexico, and Peru. We examined their environmental and social disclosures across 6 thematic pillars. And this is what we found. Mexico and Chile lead with average scores of 53 and 50 out of 100 respectively. Brazil and Colombia follow with 40, Peru with 37, and Bolivia at 24. Encouragingly, 96% of the banks assessed offer at least one green product. But here's the challenge. Few banks are applying their environmental and social and governance policies to their clients. Even fewer are disclosing climate or nature-related risks in their products. Despite the momentum, implementation could be better, and that's where the opportunity lies. Only 18% of the banks show robust ESG implementation, so there's room to work there. 9% have adopted net zero targets. Nature finance is largely absent. And shockingly, not a single bank has made a deforestation-free commitment for its clients. This in a region home to the Amazon, the Maya forest, the Mesoamerican reef, and the Pantanal is something that makes us a question mark, puts us in a question mark. We're seeing patchy disclosure frameworks and inconsistent regulatory approaches holding the sector back. Brazil is beginning to lead in regulation, but more needs to be done regionally. To close this gap, we must recognize the complex interdependent relationship between climate, nature, and people. Biodiversity loss is not just a conservation issue. We believe it's a systemic risk to our economies, financial systems, and society as a whole. It also threatens our ability to meet climate goals. Banks, as stewards of capital, have a unique and powerful role to play. They can integrate nature-positive practices, promote biodiversity-linked financing, and support investments that ensure a resilient, inclusive, and sustainable future. Let's make no mistake, transformation is within reach. I think this panel is going to be addressing that. But this will require bold decisions, strong partnerships, and renewed commitment to innovation and accountability. Thank you so much for this opportunity, and back to you, colleagues.
Thank you very much, Roberto. So Socorro, we're going to go to you now, and then Roberto and I will gracefully find a way to dramatic exit. But just please, I want to make sure participants are reminded that we do have translation. So please look at the translation button in case you need that. Socorro, it's my honor to give the floor back to you. Thank you.
Thank you, Babak. Good morning, everybody. I'm very happy to be here with all of you in this important seminar about advancing supervisory action for sustainable banking in Latin America. Latin America's financial sector faces mounting challenges from climate change, biodiversity loss, and shifting global expectations around environmental and social accountability. A key focus of this webinar will be on how regulators can support more consistent disclosure practices, enhance portfolio-level risk assessments, and align national frameworks with global standards such as the TNFD, the ISSB, and the NZBA. We have three distinguished panelists that will help us reflect on the evolving role of supervisors in guiding the transition toward a nature-positive and climate-resilient financial system, especially in a region with rich natural capital and heightened exposures to systemic environmental risks. Solange Bernstein is chairwoman of the Financial Markets Commission of Chile. Aaron Vermeulen, lead finance practice of the World Life Fund, and Hernando Jose Gomez, former director of the National Planning Department of Colombia. I will not present the panelists' bios because you already have that information in the documentation of the panel. So let's get started. Solange, given your leadership experience across Chile's financial supervisory institutions, how do you see the role of financial regulators evolving to integrate nature-related risks into traditional risk-based supervisory frameworks?
Thank you, Socorro, and thank you everyone for the invitation to participate in this panel about this important topic that for us at CMF, the financial regulator in Chile, has been quite important, and we have been implementing significant regulatory changes during the last years to address this challenge. Financial regulators play a crucial role in integrating emerging risks into traditional supervisory frameworks. I don't know if we can call this an emerging risk anymore because it's so present at the moment. And nature risks are not an exception. Globally, regulators are increasingly recognizing nature loss, such as biodiversity decline and ecosystem degradation, as possessing material financial risks for financial institutions. In Chile and across Latin America, this awareness is translating into action, as Babak was mentioning in his initial remarks. In this respect, early stage regulatory initiatives mirror the path taken with climate risk integration for the case also of nature risks. In the case of banks, while nature risks, including climate risks, are not yet embedded in minimum capital requirements in Pillar 1, they are beginning to be considered under the supervisory review process in Pillar 2 and disclosure requirements in Pillar 3. The same is going on in the side of insurance company, which are also exposed to nature risks on both assets and liability sides. In Chile, as financial supervisors, we started focusing on climate change risks. In 2020, we published our strategy for addressing climate change risks, which includes among its pillars our focus integrating climate and environmental risks into prudential review process. We have been working on stress testing scenario kind of things, exercises for the banking industry. The teams are working on developing tools and regulatory proposals to address this challenge effectively, and we have been extending our work to include broader perspective and address also nature risks more generally. So that's the way we have been working on, Socorro.
Thank you very much. Thank you very much, Solange. Aaron, based on the findings of the WWF's 2025 Sustainable Banking Assessment, what are the most critical gaps in how Latin American banks are currently managing environmental social risks?
Yes, thanks for that question, Socorro, and thanks to Toronto Center to invite me to this fantastic panel, and good day to everyone listening. So one step back. So what is SUSBA? What is the Sustainable Banking Assessment that WF is conducting every year in different regions? So it's really an assessment of the environmental and social footprint of the bank activities. So that includes underwriting, advisory, but also the behavior in the capital markets. And it's really an attempt to encourage the banks to evaluate how their clients operate and produce, and what is their respective impact on environment and people. So it's not a naming and shaming type of list. It's really a kind of a benchmark to facilitate a discussion between banks and supervisors, but also between banks and their investors to see how they're doing in terms of climate and nature. And we really hope that on the back of this, the banks engage with clients to take climate and nature into consideration in their business operations, but also to provide incentives to their clients in the shape of new financial instruments. And WWF is really keen to use this tool, SUSBA, as a way to create systemic change in the financial industry. Well, maybe it's no news to many of you, but banks are facing different types of risks. So we make a distinction between physical risk, reputational risks, systemic risk, but also transition risks. And I just want to highlight one interesting example. A couple of years ago that we did in India. We looked at the Indian banking sector, and we looked to what extent they were exposed to water-related risks, and we found out that about 40% of the gross credit exposure of the Indian banks is in sectors where water risks are significant. So that was a balance sheet risk for some of the banks, but also a potential systemic risk from the perspective of a regulator. So now coming back to your question, Socorro, on the improvements that well, we would like to see based on this benchmark that we did this year. And Roberto already alluded to some of that, so I try not to repeat some of the findings. But in general, I think, the report mentions that the development of general environmental and social policy is grossly lacking in most of the banks. And more specifically, sector-specific policies, because every sector is exposed in a different way to nature and climate-related risks, are also lacking. So, and that also hampers the integration of climate and biodiversity risk integration in financial decision making. What the report also finds out is that a proactive engagement with clients and other stakeholders between banks and their clients on these topics is missing. So, which then also hampers the flow of information from clients to banks and the other way around, which could be the basis to take action. Roberto already mentioned that clear commitments like deforestation, free commitments is lacking in any of the banks in Latin America, which is surprising given the fact that you are sitting in such a forested continent. When it comes to climate, well, the good news is that about 55% of the banks are taking steps to disclose their net zero commitments. But it's still, Roberto also mentioned that figure, only 9% have set net zero commitments. So still, considerable work to be done on nature and climate. Back to you, Socorro.
Thanks, Aaron. Hernando, now we go to you. Having worked across public policy and the financial sector in Colombia, how can national development strategies in Latin America better align with supervisory efforts to address climate and biodiversity financial risks?
Thank you, Socorro. Good morning to everybody, and thanks to the Toronto Center for this nice invitation. Colombia has benefited from the close alignment of its financial sector, supervisory bodies, and public policies and regulations. Specifically, two entities with strong technical capabilities and continuity in its policies and priorities have achieved the necessary credibility in both the public and private sectors. Those two are the Superintendencia Financiera de Colombia, Financial Superintendency of Colombia, and Asobancaria, that is the Colombian Banking Association. Cooperation between public and private agencies is essential to address climate and biodiversity financial risks and with a comprehensive vision. Since 2013, the National Planning Board of Colombia, DNP, established the Committee for Climate Finance. Its main goal is to incorporate climate change considerations into the country's economic and financial planning, execution, and evaluation. Asobancaria created the Green Protocol in 2012, a voluntary framework for banks to discuss initiatives that benefit both the environment and their loan operations. In 2022, the protocol was renewed and updated to incorporate a climate finance approach. Furthermore, the Superintendencia Financiera undertook a project to define a green taxonomy to classify sectors according to its sustainability, an important step forward in developing tools to align supervisory efforts with environmental risks by classifying loan portfolios based on their environmental impact. However, these initiatives are currently non-binding, and as they have not yet been formalized into government regulations. In terms of coordination with national development strategies, a compulsory analysis of the environmental financial risks of public investment projects involving private funds, such as public-private partnerships, PPPs, for infrastructure development is crucial. This is because these projects, particularly in geologically unstable areas or fragile ecosystems as those in our countries, can create potential financial risks for banks that might be overlooked initially. Another recent effort is the establishment of the Fondo de la Vida y la Biodiversidad at the Ministry of the Environment, partially funded by carbon tax revenues, like 80% of the total. A substantial portion of these resources should be allocated to capacity building in financial institutions and to incorporating risk reducing or diversifying elements into the project designs of a public investment. Furthermore, mobilizing private resources to support the adoption of environmentally friendly technologies or those that preserve biodiversity is vital. This can be achieved through two mechanisms. First, by encouraging banks to equip loan officers with the knowledge to distinguish environmentally friendly technologies. A specific example about this is, for example, for manufacturing firms to help them identify more sustainable boiler and water pumps options when they have to change these machines at their plants. Second, by providing government subsidies that reduce interest rates on loans for these technologies, making them more attractive to businesses. In conclusion, economic policies offer numerous avenues for financial regulators to mitigate climate and biodiversity-related financial risks, provided that policymakers are directed to integrate these concerns into their decision-making processes. Thank you. Socorro, back to you.
Thank you very much, Hernando. This has been a very interesting first round with a lot of insight on the issues at hand. We go back to Solange. Chile has made progress on ESG integration. What specific supervisory tools or policy innovation do you believe could help close implementation gaps in E&S risk management across Latin America?
Thank you, Socorro. In the case of the CMF as financial regulator in Chile, we have issued an ESG reporting standard in 2021, which gathered the best international standards that were available at that time. We included in our regulation TCFD guidance, GRI, SASB, and now we do have IFRS, ISSB, which entered the scene in 2023, building on the same foundations which provided a comprehensive global framework for sustainability reporting. Also, IOSCO, of which we are members, endorsed this standard. Therefore, last year, we decided to incorporate the convergence to IFRS, ISSB into our regulations that would start in the reporting that would come out in 2027 that referred to the company's performance during 2026. So from our experience, there are some preconditions needed before incorporating these new ESG regulations. The first thing is to facilitate the public-private dialogue. It's very important to keep that dialogue in a very rich way. So public consultation process to raise awareness of the importance of this closing sustainable information, nature risks, it's very, very important so that companies realize how this would impact companies' results. Interoperability and common global language on sustainability reporting is also very important for issuers and investors and the financial institutions. Indeed, effective international cooperation helps to prevent regulatory arbitrage and complaints. So a unique standard reduced reporting and verification costs, so countries can now are better placed for ESG reporting now that we do have this consensus in terms of the standards of IFRS as ISSB. So that is a very important step. Also data, to have systemized data. ESG reporting can be very extensive, and we do need very specific and technical data that will come up into those reports. And this has a cost, but it also needs to be information that it's material to assess the company's stand. We have developed a set of indicators that institutions must report, which is aligned with SASB standards. And we are trying to systematize that data, that information in a very easy way for the general public to be able to navigate that information. So we have built a Microsoft Power BI tool that you can go into and look into that information. For nowadays, it's just internal, but we are planning to release that information for the general public to be able to understand better what's been on those reports. And for now, it's a supervisory tool. Also, in terms of the extension of the reports, we do have a lot of information, and these reports are difficult to navigate. So sometimes keeping it short, it might be better and very focused. Also, we have found that it's very interesting that we do have technological tools now, artificial intelligence, to navigate these reports and analyze the information. It has been important. Financial educations to reporters, the general public, to understand better the information that's now available. So how can supervisor be better prepared? Training, there's a lot to do in terms of training. There's a lot of information available, literature, courses, guides, so on and so forth. Also learning from peers and third-party verifiers, which are coming up. International organizations like Toronto Center, the academia. So there is a lot to learn from each other. I'll leave it there, Socorro.
Hi, I'm sorry, I'm having some connectivity problems. I don't know if you can hear me. Can you hear me?
Yeah,
Yes,
we can hear you now.
Okay, thank you very much. Sorry, Solange, I didn't hear the last part of your speech. I'm sure it was very, very insightful. How can supervise more closely with civil society and institutions like the WWF to align national risk frameworks with global standards such as TNB?
Thanks for that question, Socorro. I think I heard the question properly. If not, please follow up with another question. But yeah, first of all, I mean, WWF and many other NGOs, they are very keen to create awareness in the financial sector, including supervisors, about the risks for nature, climate, people, and the economy of degradation and climate change. So it's not only WWF, but also the World Economic Forum estimated that about 55% of GDP depends on nature and nature loss. So if we are not successful in bending the curve of nature loss and halting climate change, a significant amount of GDP will be impacted. But also, these are not independent issues, right? So climate and nature are really interconnected. So on one hand, nature stores about half of the current anthropogenic emissions or emitted by the economy. But at the same time, nature hedges communities and economies against the change of climate. So the financial sector is increasingly recognizing this interconnectedness of climate and nature, and starts to understand that biodiversity loss poses systemic risk to economies and financial systems. So the SUSBA assessment was based on 6 pillars that include purpose, policies, processes, people, products. And what we noticed that, especially in Mexico and Chile, there was a stronger performance of banks, especially on their sustainability strategies, the way they engage with stakeholders, but also sector-specific public statements. And we see a clear correlation with the regulatory frameworks in these countries and the response of banks on these frameworks. But of course, also credit to the banks because they've been also investing in training and capacity for their staff. And I want to share a couple of examples from different countries where supervisors are engaging on climate and nature, just as an example where WWF and other NGOs are working with central banks and supervisors to improve the regulatory and supervisory environment. So like in Brazil, Chile, and Colombia, they have introduced sustainable finance frameworks and green taxonomies to guide banks in redirecting capitals towards projects that work for climate and nature instead of against it. Of course, it's very important that these frameworks are implemented and that the bias is not only towards climate-related taxonomies, that we also see sector-specific taxonomies related to nature. I'm particularly also excited about the Central Bank of Brazil and the National Monetary Council of Brazil that introduced an enhanced disclosure requirement and established rules for incorporating ENS policies and climate risk analysis. In 2021, the Financial Superintendencies of Colombia issued a regulation with instructions regarding the disclosure of information on social and environmental issues, including climate-related issues, and very aligned with the TCFD and SASB frameworks. It has also been a framework for the green bonds that are launched in that country. I also want to commend Mexico. Mexico was one of the founders of the Network on Greening the Financial System that was launched back in 2017. By now has over 100 central banks as a member, and there's even a dedicated task force on biodiversity to build awareness, but also share experiences in how central banks are integrating biodiversity in the way they manage risks. So back to the question of Socorro, how do we also work with central banks on the back of all these examples that I just shared? We have a Greening the Financial Regulation Initiative, which is a global initiative. We have a similar benchmark for banks. We have that for central banks. It's called SUSREG. This framework is being launched and updated every year, where we really compare about 40 plus central banks in all over the world, how they are improving their supervisory standards when it comes to climate and nature, receiving a lot of positive feedback from these central banks, and really facilitating a dialogue between central banks and exchanging lessons learned between these central banks as well. So that's in a nutshell what we are doing in our engagement with central banks, Socorro.
Thanks, Aaron. Hernando, lessons from Colombia growth issues could be scaled across the region to meet its vision.
Yes, thank you, Socorro. There are several lessons to be learned from Colombia's green growth initiatives. Particularly, just I was remembering that we started with the green growth mission that was organized by the National Planning Department, and generated a lot of interest and excitement from both regulators and in the private sector to have a better knowledge of what were the opportunities that were open there. One key takeaway is the need for a leader with both technical and institutional credibility in both the public and private sectors who can attract international cooperation resources. For example, in the case of Asobancaria, international cooperation provides resources for this association to work with its members to implement the green taxonomy that was referred by Aaron, or to incorporate environmental and social risk management systems, the so-called SARAs, to assess their portfolio. This requires moving financial institutions out of their comfort zone to explore financing projects in green growth areas where they may be unfamiliar with business models and the net impact on climate and biodiversity risks within their financial portfolios. In this sense, Asobancaria acts as an aggregator of funds, facilitating the generation of critical mass to implement programs of this magnitude. Examples of areas where banks will still face limitations in assessing operational risks for the portfolios include, for example, carbon markets with private banks and the production and value chains necessary to make ecological restoration projects viable, or for agriculture, forestry, and other land uses follow. These types of knowledge is crucial to facilitating the development of blended finance for sectors that the government want to promote, but where the financial sector still require technical capacity for environmental risk assessment. The Financial Superintendency recently announced its intention to mandate SARA's adoption for all banks, evaluating the operational, environmental, and social risks of their portfolios. Additionally, they plan to impose specific decarbonization goals and timeframes for banks' loans portfolios. While we believe most financial institutions, except for the largest ones, are not yet mature enough for such compulsory targets, we suggest a phased approach to avoid unnecessary resistance from them. By requiring all banks to adopt the SARAs, environmental and social risk management systems, with a standardized methodology and publicly disclose the evaluation results, we can create a healthy competitive environment among banks. This transparency will enable the public to better understand the financial impact of banks' loans decisions and incentivize them to improve their environmental and social practices. Socorro, back to you.
Thank you, Hernando. Now we move to questions from the public. We have several questions. We'll start with Aaron. Aaron, this is a question from Richard Goyal. Aaron mentioned the interface between supervisors and banks, as well as banks and their investors. How do investors perceive nature loss risk in Latin America, and push is coming from investors on banks? What role can supervisors play to create investors' awareness? Yeah, this is for you, Aaron.
Yeah, thanks, Socorro. Well, let me tell you a story. I'm active in sustainable finance for more than a decade now. And when I started in finance, first the awareness and action was taking place in the climate carbon space, right? And then I gave you the example of our work in India on water. That was the next frontier. And it's actually since a couple of years that the financial sector, including investors, are waking up to nature. And let me give you some figures of how investors now are committed to the nature agenda. So the TNFD, the Task Force on Nature-Related Financial Disclosures, was launched only 2 years ago and now has over 500 adopters, including 1/3 of that is coming from the financial sector, including investors that are committing to disclose nature-related risk and take action on that. There's also a group of 230 investors that have signed up to Nature Action 100 Plus. that are looking at the top 100 companies that are most exposed to nature-related risks. So that these are large-scale investors that want to understand how these companies are moving fast enough to towards nature positive. And then you have another platform called the Biodiversity Finance for Biodiversity Pledge, which is a 5-action point agenda to which financial companies can sign up. Also only started maybe a bit more than 2 years ago, and now already have more than 200 signatories. So the financial sector and also investors are closely paying attention to how their investees are acting on nature-related risk, but also on how they're moving their portfolios towards nature-inclusive opportunities. And that includes banks in Latin America. Latin America is one of the most biodiversity-rich continents in the world. It's also one of the fastest growing economies in the world. So the two of them could go in tandem if companies and banks are doing it right. Thank you.
Thank you, Aaron. Now we move to a question for Solange. Let's see. Solange, this is a question from Elizabeth Ryder. What do you see the most urgent supervisory priority in addressing nature-related and climate risks in Latin America today?
Hi, Socorro. I think there's a lot to do for supervisors, and we do not depend only on what we are doing, but it's a global problem and it's a national problem in terms of having, for instance, good data, because in order to be able to assess risks, to manage risks, data, it's critical. So I would think that it's a big challenge that we need to address, not just us, but also our statistical reporting national institutions. Also central banks play a role there. So data is very important. Another piece that is also nationwide, it's taxonomy. What is considered to be sustainable or not sustainable to avoid greenwashing. I think that's also a very important piece that does not only depend on financial supervisors, but also it's a national challenge. And in the case of Tilia, we're working on a national taxonomy of environmental sustainable activities. Also, technical tools, I would say that is also very important. This is not, we might not be able, and it was mentioned before, the traditional methods might not be the best way to quantify, manage nature risks or climate risks. This kind of scenario analysis that the NGFS it's promoting, and we have been working on that type of things. And indeed, we did some exercises for the banking sector to try to assess which is the exposure to physical and transition climate risks. And we do have some results on that end. But it's not something that it's mature enough in terms of the kind of methodology that it's used to address those risks. So let me mention a fourth one. It's to have assurance and verification of what is being disclosed. So we do have disclosure, but then we have to assure that disclosed information it's good quality and credible. So I would think disclosure, taxonomy, assurance, data, and methodology and techniques in order to assess risks. So all of those challenges as supervisors we are facing to better manage and better include this kind of assessments on our supervisory exercise.
Thank you, Solange. Back to the questions. Let's see. There is another question from an anonymous attendant that says, how can country successes support learning and lessons to other countries in the regions? Are there insights on market tipping points for change in both banking and supervisory practice? I guess this one is also for Solange.
Thank you. Initiatives like this one, I think they do help to share experiences. We can share our experience. We have the same challenges, but in different stages into our path there. Also, in terms of global standards, I think that's also very important. We need a common language, as I mentioned before. So in our case, as emerging markets, I do think it's very important to participate in global standard setting bodies in order to incorporate our own challenges and problems that might be different from the ones of developed countries. So if we contribute actively in terms of standard settings and on sharing our experience, and I mentioned some of the challenges that we faced in the case of Chile. Also, something that I think we can do and we actively do is not just share our experience, but also do analysis and try to assess how are things working, to do some exercises and see if we are having success or not, and share that as well. Well, I would think that would be the main things that might contribute to the global understanding.
Thank you very much. Hernando, this one is for you. How can supervisory authorities ensure that voluntary initiatives like the Net Zero Banking Alliance translate into meaningful regulatory and institutional action?
Yes, thank you, Socorro. I think that, as I mentioned in previous answers, a fundamental condition is the existence of an institutional framework where the private and public sectors have recognized leaders to create a climate of trust, allowing banks to accept the need to incorporate analysis and evaluation tools like the green taxonomy and SARAs as an integral part of their lending activities. In Colombia, this is the case for the financial superintendency and for Bancaria. I believe that the financial superintendency should initially mandate all banks to incorporate classifications and measurements of the carbon footprint of their portfolios, such as the green taxonomy and the SARAs, and make the results public and transparent. However, instead of imposing from the beginning with specific regulatory targets, a more productive approach, I think, could be one of self-regulation, where each bank commits to improvement targets regarding the reduction of environmental risks, which the superintendency would then monitor for compliance. Later on, when the banks have similar capabilities for management, environmental and social risks, mandatory standards with specific targets could be established. And really, I would like to add that the capabilities of banks, of different banks, are really different in this area of assessing environmental risks. Large banks, maybe the 2 or 3 largest banks in Colombia, are doing it well from a couple of 2, 3, 4 years ago. But smaller banks still have a lot to learn. They need a lot of support from the supervisory agencies and probably also by the bank association. So I think we should go step by step, just to avoid the resistance from the banks to incorporate all these new assessments, and to make them understand the benefits that they are going to get from incorporating this type of analysis. Back to you, Socorro.
Thank you, Hernando. Aaron, in your experience, what are the most effective ways for banks to move from disclosure, real portfolio level transformation toward climate and nature?
Yes, thanks for that question, Socorro. I think it all starts with disclosure, of course. It's very important that banks identify the material risks in their portfolios and not only look at financial risk, but also risks for climate and nature and people, right? So it's this double materiality approach that is really important. But once banks understand what risks and opportunities they have in their portfolios, it's important that they set targets, right? Because we can't move to net zero tomorrow. We can't be nature positive tomorrow. We need to put these targets in the near future and develop transition plans. And then it's really important to think about how you can, as a bank, align your portfolios with net zero and nature positive. Then, of course, it's important that you don't. What we see a lot in the banking sector is that banks then start to divest in the more risky business and look for the more green products, green clients. But we really see a very important role of banks to play a role in that transition of the real economy and support clients in that transition as well. So on one hand, when you look at the sovereign side, there are a lot of financial products, sustainability-linked bonds, debt for nature swaps, where banks can invest in sovereign products that can help country-level transitions towards net zero and nature positive. But on the non-sovereign side, there's a growing portfolio on investment opportunities, lending opportunities that include nature and climate. So on one hand, banks can support their clients in transitioning towards more sustainable production by deploying sustainability-linked loans and providing a discount on the interest rate if they meet certain KPIs. And WWF is very active together with development finance institutions and concessional capital providers to develop blended finance instruments in emerging markets, especially in the agricultural sector and the forestry sector, to really allow or to help companies get access to capital to produce more sustainably and then transition towards more sustainable business practices. So these are just a couple of ideas how banks can start, Socorro.
Thank you, Aaron. We have time for one last question from Lei Gio. I don't know if I'm pronouncing the name correctly, probably wrong, but this one is for Solange. We all know that it is very difficult for banks to be fully committed to deal with climate change. I mean, they have all sorts of other priorities. So what kind of supervisory strategies can the supervisor undertake to get banks to speed up the process?
Thank you, Socorro, and thank you for the question. As I mentioned, in the case of the banking sector, it's part of our supervisory assessment, and what we do as supervisors in Pillar 2 is try to understand how banks are managing risks, including nature and climate risk. So that's one step, and disclosing information on the sides of banks. How are they managing the risk and how exposed they are is also a very important piece. But also, I think raising awareness on banks in terms of what's the impact of this kind of risks on their own portfolios. And as I did mention, we did a study in 2024 to try to assess how exposed are banks. And let me give you some figures there that we have published in this study last year in terms of the exposure to physical and transition climate risk on the commercial portfolio of Chilean banks. And what we found there in our analysis is that in the case of physical risks, the exposure of commercial loans to economic sectors that are intensive in natural resources is 11% of the portfolio. So that's a significant impact in terms of physical risks exposure on the bank's commercial portfolio. And in the case of transition risks, the exercise that we did is a sudden increase in carbon tax, changing from $5 to $75. And what we found is, in that case, is that 20% of the commercial portfolio is exposed to this risk. So quantifying on the side of the supervisor, if we have the tools in order to show banks how exposed they might be to this kind of risk, also helps to raise awareness. So it's a supervisory exercise, also the market discipline of disclosing this type of information, but also doing our own analysis and disclose this information, how much exposure there is actually in the bank's portfolio. That might also help. Thank you. So
Thank you.
back to you.
Thank you, Solange. So it's helping banks understand that their incentives are aligned with reducing the impact of climate change. Thank you very much. Well, I want to thank all the participants, all the panelists and the participants for the questions, this very interesting panel. And well, it is time to adjourn. So have a good day, everybody. Goodbye.
Thank you.
Bye. Thank you.
Yes.